Today we have Francesco Serpe here with us from Mortgage Alliance, and I want to thank you for coming. Mortgage Alliance in Vaughan, Ontario.
Thank you for having me. Big fan of the podcast, and
Thank you.
Truly honored to be here.
I really appreciate that. So why don't we start off by maybe giving me a background about yourself. I always like to hear a person's story, how they got into what they're doing today, whether they were on that path their whole life or whether something totally changed and they got there. So why don't you share with me and the audience on how you got to this point?
Yeah, it's funny. I guess you could say I grew up in the industry prior to moving into the broker channel and the broker world in which I'm currently working in. I worked for TD Canada Trust, which is one of Canada's leading lenders, one of Canada's leading financial institutions for 19 years. Started off as a teller in Etobicoke in the GTA and worked my way up the ranks to sales manager of the MMS channel, mobile mortgage specialist channel, before departing in January 2023.
Oh, so just recently?
Just recently, but I guess you could say I've been in the industry for years.
Yeah, sounds like a lot of years, yeah.
No stranger to lending, for sure.
That's great. Okay. I wanted to know more on you as a teller. Okay, so you got into finance right away. What got you to mortgages? How did you find mortgages?
Yeah, it's funny. I guess you can say that I fell into the finance world. Working part-time as a college student, I was looking for opportunities to pay my bills, go out and have fun.
Yeah, of course.
And I applied to the bank and got a job as a teller, loved it. The whole idea of being able to dress professionally and deal with people's finances really was up my alley. I didn't know exactly what I wanted to do, but I'd say soon thereafter, having worked at a financial institution for some time, I was drawn to the whole lending side and helping people buy their homes, looking for solutions to help clients buy their first house or refinance their existing home as a financial advisor. And I guess you can say I fell into it that way and got carried away with it. I did a stint with commercial banking as well. I did some commercial mortgages and really got a sense of what it took to do technical loans, into the nitty-gritty of business financial statements and working with the business clients as well.
Which is a lot more rigorous, I would say, probably.
A lot more rigorous, but in the grand scheme of things, it gave me a huge advantage over other individuals, even shifting back into residential mortgages, because I'm able to read financial statements and work with the ins and outs of commercial lending. That's a great one, yeah. To be able to understand a business, how it works, all its in-depth, its money income and all that stuff. It's fantastic, and I'd say the experience at a financial institution, for anyone looking to get into the industry, I'd say the experience that you gain from a financial institution and the training offered from a financial institution is by far second to none. In this industry.
So I don't know if you know this, but when I was like 19, I actually worked at TD as a teller.
Yeah, I know that, yeah.
And I did teller for about a year.
Yeah.
It just wasn't for me. Being in bureaucracy wasn't for me. Being in the corporate world, I needed to do something on my own all the time.
Yeah. The biggest thing is the autonomy that you get in this world. The autonomy and being able to do things like this with your daily schedule is huge. And it's such a big part of business development, being able to connect with the public, and being able to spread the word and let people know about what you do.
And also that drive and passion and that responsibility of being on your own, of doing something on your own and having that accountability is challenging.
Could not agree more. Could not agree more.
It gives us purpose, right? Something to wake up for.
Absolutely.
Which is good, okay. The next step would be to talk about the housing market and the mortgage market as it is today. It was all this conversation. Personally, I don't really go on social media too much. I know I post a lot of videos now, but I'm not listening to a lot of what's being said, and I have reasons for that. But interest rate talks are in the office now. They're pretty much everywhere. You're at a coffee shop and you're hearing interest rates talk. But let's talk about the housing market and interest rates today.
Yeah.
They're higher, obviously.
Yeah.
They should be at a point where they sustain a level of sustainability for our economy, for the people, for government to proceed and keep going.
Yep, absolutely. Over the past year and a half now, we've seen interest rates both on the Bank of Canada side as well as the banks' fixed rates go up gradually at some points throughout this past year and a half. Gradually probably wouldn't be the word that I use. They were quite rapid with interest rate hikes. But we've definitely seen an increase in interest rates, both coming from the bond markets going up. It's funny, right before filming this episode, I got an email that one of our lenders is increasing rates, and that's absolutely directed, and it's absolutely impacted by bond yields going up as well.
It hasn't been 2 weeks since the last thing I saw was that they were holding the rates. At least Bank of Canada was.
Bank of Canada was holding on the fixed rate side. We have another announcement coming up in October. It's going to be interesting to see what direction they want to go in. Inflation's a bit higher than August inflation numbers came in a bit higher than what they were in July.
What was that number? Do you know?
So in July we were at 3.2% inflation,
Okay.
whereas in August the reports came out at 4%. So
Okay.
we saw a good spike in inflation, and those numbers were largely part due to gas prices as well as housing costs.
Housing costs. Okay.
Yeah. The consensus right now across the board may be that we'll see a hike in October, but it remains to be seen. We're still a ways away from that, and the Bank of Canada governor definitely has his work cut out for him in assessing
Sure he
and making
does,
that
yeah.
decision.
A
Absolutely.
lot of people are upset about these interest rate hikes, and
A lot, yeah.
I wanted to clarify for the viewers what the affiliation is between bonds and mortgages. A lot of people say this, and I understand it pretty much, but how does a bond affect or relate to a mortgage rate
Yeah.
in any way?
Great question. I'll start with our variable rates. So our
Okay.
variable rates are directly impacted by what the Bank of Canada decides to do when they meet
Okay.
on their set out meetings. So we had a meeting in September. Our next one is coming up in October. So that decision directly impacts our variable rate and directly impacts the consumer's variable rate mortgage. Whereas on the fixed side, when a client
Okay.
comes into
Do a 2-year fixed or 5-year fixed mortgage,
2, 3, whatever
and
it
it's
is.
usually a
fixed
better
mortgage.
rate at the fixed,
If we-
upfront stated.
If we look at history, the variable rate will beat out.
Correct. I've seen that as
fixed rate.
well. On a paper, if you give me a piece of paper with all the years and all the interest rates, the fixed would look cheaper.
At this point in time, we're starting to see fixed rates looking a bit more attractive.
Okay.
We have clients that are looking at 3, 5-year fixed rates, and the bond market directly impacts those rates.
Because it's technically a bond. A bond is a loan. Okay. So a bond it could be a government bond is
Correct.
and there are tax-free government bonds and there's municipal bonds as well. But we'll say government bonds and people putting up money to create this loan. So when you hear government printing money, it doesn't work like that. It's a loan taken out as a bond. Okay, and then this bond is paying interest, guaranteed interest by the government
Exactly.
to the bond holders for a specific period of time, over a specific period of time. So I guess the fixed rate from the bank on the bond would be how much can I borrow and then add to make a profit.
Exactly. And naturally, as we see those go up, we see fixed rates that the bank offers their clients also go up.
Okay, so the time value of money based on that time and point of bond prices.
Precisely.
Okay, that's pretty cool. Since we're on interest rates, how do you think it affects people who have mortgages? Like, for example, some people are going to renew this year, and some people have 3 years.
Yeah.
What do you say about that? Are we seeing defaults yet?
No.
Had a year of interest rate hikes. Are people defaulting? Are they on the streets yet?
Very good question, right? And certainly if we look at clients that are coming up for maturity on their fixed rate mortgages, or any mortgage that they may be in for that matter right now, the fact of the matter is that they're going to be renewing into something that is much higher than what they are renewing from. That adds stress onto their mortgage, that increases their monthly budget or their weekly budget or their budget entirely for their mortgage.
What if they don't qualify based on current prices still?
Yeah, so at renewal, typically a client has the opportunity to shop elsewhere at another
Okay.
institution. That's like their time to do it without any fees that may come to break into contractual
Right,
agreement of the
okay,
mortgage. So they have the opportunity to do that, or they have the opportunity to just stay where they are and renew with their current lender. But that said, as I was saying earlier, with a big book maturing this year, we're going to see a lot of clients that are in over their head, I guess you can say, or they're going to have a much
more
Yeah.
in interest
They're
than they had when they first got their mortgage, right? So, yeah, 3 times more interest payment.
they're going to have a much higher monthly obligation or periodic
Do you
obligation.
think they'll extend the amortization period to assist, or no?
There's been talks of that. There's been talks of them. When I say them, I say financial institutions, because every financial institution has to work with our governing body, which is FSRA, right?
Okay.
And FSRA has to approve everything. The government body has to approve any changes that financial institutions make to their instruments. If it's not granted, then although it may seem ideal to us,
They still have to approve it.
it has to be approved by the governing body.
The governing body of mortgages.
Absolutely, of
Yeah, that
lending.
makes sense.
There's always talks about how to make things more affordable. A longer amortization period would make sense in the grand scheme of things.
But it also has its risks.
It does have its risks associated with
So
it.
let's get back to that question. So I'm really curious. As of today, we are September 21st, okay? And
Correct.
I'm curious to know, are people defaulting as of late? Are you hearing anything within your circle, or are you seeing it firsthand?
Yeah, it's a lot more difficult to qualify for a mortgage nowadays, especially when we look at our traditional lenders being big financial institutions. One of the things that I work by and I stand by is the fact that we have alternative methods and there's always a solution for any client, right?
So you're talking, if they can't go with a bank, like a big financial institution, we'll call them A lenders, then they can go to a B lender.
Absolutely,
Which
yeah.
would be another financial institution that does, call them riskier mortgages, or
Yeah, they'll look
less
at
regulated, perhaps?
less regulated or more alternative methods.
Alternative products to
getting-
provide for consumers.
Exactly. And now, in this capacity that I've been working in since January, I have access to those lenders, and it's a whole suite of lenders that I have access to, both, I'd say, on the A side as I do on the B side. And then the further we go down the chain, there are other methods, such as private mortgages, to which clients have access to as well.
And the privates, how are those doing right now?
I'd say I've noticed personally a big shift in my business from A and B to private, for the very reason that we have clients that don't want to go through the stress of providing what feels like an abundance of paperwork for a financial institution, and would rather secure a rate.
Jumping through too many hoops.
Jumping through too many hoops, too many conditions associated with getting the deal done, and they'd prefer just locking in with a private lender.
And what's the difference between rates? If you had, let's say, B lender versus, because I know that A lender is one rate, B lenders would usually be a higher rate. Is it ever a lower rate than a bank? Not
typically, no.
Typically, no. Okay, so we could fairly say it's usually a higher rate, B lender.
Slightly higher rate with a fee associated.
So there's an extra fee associated, which is what, 0.5% or?
It varies on the lender.
Okay.
But yeah, you'll get a lender fee with a B mortgage or a B lender. And then surely as we go on to the private side.
The private, and what would that interest rate be on average?
Yes, in the private world right now, we're looking at, I hate to put numbers on things because as things change all the time, 10 plus.
So 10%.
Yeah.
So you'd have 10% on a private, plus obviously a fee as well.
Plus fees included in that, absolutely, right? Okay. And then on the private side, you have your construction loans, you have various types of loans within that as well.
Okay.
Yeah.
I guess we can fairly say not too many defaults yet that we've been witnessing. There could be some, but we haven't been really witnessing any of them yet. And because even I have clients too, we deal with a lot of people. We have pre-approvals for pre-construction. We have mortgage commitments for. We have obviously the mortgage clause in resale properties to conditional upon receiving financing.
Right.
And the reason we do that is to protect people, obviously, and so they can make sure they get their financing in place without being stuck to the property.
Exactly.
And they're still getting it. They're still getting their financing. They're somehow still finding a way to get through this.
I always say people are resilient.
They're exactly.
They're going to find a way to make that obligation.
And people were afraid of, like, I spoke with a lot of people about lending banks, and for some reason, people are afraid to pay interest. Or they prefer not to. And that's not wrong, right? It's understandable why you want to pay interest. But to pay a little bit of interest is not the measure. It's the measure of profitability, or are you going to get what you want to get out of it? So, for example, if you got to pay a 2% difference between an A lender and a B lender, if it's worth it within the numbers, then it should be fine.
I agree. And I think if I go back to my days that I was working for a major institution, I'd say, especially 6-7 years ago, there was a huge stigma, right, associated with the more alternative options of borrowing money.
Sure, because we had 1% interest rates, or you had
or
2%.
Or even for that matter, working with a broker. Huge stigma associated with it. But I think the fact of the matter is, and as we're moving along and working down the chain, we're starting to see a lot more of the financing and mortgage professionals moving into this type of a role and this type of capacity, just because there's more to offer to our clients.